Welcome to my channel. I'm going to show you step by step how to value a stock. We will enter the company's financial information and capital structure into my Excel model. Then we determine whether the stock is a buy or a sell. At the end, we calculate and analyze the financial ratios. I am doing this with you throughout the entire video, so it's like we're doing it together. The company we're going to look at today is SBA Communications. This is a REIT, and they own and operate wireless infrastructure. Let's get started with the model. This company has a market cap of $34.1 billion. It's a pretty good sized company. And let's get the stock price. That's $304.63 for only one share of stock. Now let's pull the free cash flows. And the way you value a company is you estimate the future free cash flows, then you discount that back to today's value. That's what we're doing in this video. Now let's pull the net income. That's a profit and loss on the income statement. And we'll put that into the model. And then the revenue, which are the sales for each year. And the numbers look pretty good. Their free cash flow is pretty strong and growing each year. Their sales have also been increasing. So everything looks pretty good and consistent, so we should get a good value for the company. Let's look at a capital structure. Let's figure out how much interest they pay on their debt. That's $393 million. And let's go to the balance sheet to see how much debt they have. Go to liability section. Current debt of $522 million. That's debt due within 12 months. Long-term debt of $9.8 billion. That's debt due after 12 months. Interest payments on debt is tax deductible, so let's get their effective tax rate. The income before tax is $186 million, and the income tax is $39 million. So they do pay a pretty good amount of interest. Most REITs pay little to no interest. So the cost of debt is 3%. The cost of equity, we need the beta to figure that out. And the beta is how volatile the stock is relative to the market. And they have a really low beta, 0.41, so the stock moves less than half the market. So it's a pretty low risk stock. Let's go to the balance sheet to get their current assets. We need to calculate the current ratio later, and current ratio is current assets over current liabilities. And that's $334 million. Let's see what that is. That's $108 million of cash, $132 million of net receivables, and $32 million of other. Let's also get their current liabilities. That's $1 billion. Let's see what that is. That's $500 million of current debt, $31 million of accounts payable, $107 million of accrued liabilities, $113 million of deferred revenues, and $16 million of other. Now the equity is the value of the company according to the balance sheet. That's assets minus liabilities. That's negative $3.7 billion. And that's 1.1 million of common stock, negative 5.6 billion of retained earnings. They pay a lot out in dividends, so that's why they have negative retained earnings. And negative 570 million of accumulated other comprehensive income. Let's go back to the income statement, get their operating income. That's $631 million. Now let's look at a capital structure. They're 100% debt since they have negative equity. And the cost of debt is 3%. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $24 billion. We discounted those numbers back to today's value using the weighted average cost of capital. We get a value of the company at $25 billion. We divide that by 112 million shares. We get an intrinsic stock price of $225. It's trading at $305, so it's trading at a 35% premium. So it's a sell according to the model. Let's see what Simply Wall Street says. They're at $261. So they're also saying the stock is a sell. Let's see where the stock has been trading. Looks like it's been going up pretty much little by little every year. And according to my model, there's a 50% chance of them defaulting within the next 12 months. They're a really big company, so they're probably not going to default. Plus they have healthy, positive free cash flow. It's just, it looks bad with a negative equity. But what I would look at more is the free cash flow, and that gives me more comfort that the company will probably be around for a while. Let's look at the financial ratios. The PE is really bad. Price of sales is also bad, and negative price to book, of course, because they have negative equity. The PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 232. That means investors are willing to pay $232 for $1 of net income. So this relates the stock price to how much net income the company's bringing in. So they're doing a really bad job of bringing in net income relative to what they're trading at. Let's look at the price to sales ratio. That's stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 17. So investors are paying $17 for $1 of revenue. Also, another really bad ratio. They're not bringing in a lot of sales relative to their stock price. They have a negative price to book ratio because that's price of stock over book value per share. And the way you calculate book value per share is you take the equity of the company divided by the shares outstanding. Remember, the equity is total assets minus total liabilities, and they have more liabilities than assets, so they have negative equity. Therefore, negative price to book value. Current ratio is really bad. Interest coverage ratio is okay, and ROE is terrible. So the current ratio of 334 million of current assets over 1 billion of current liabilities, so they can't cover their current liabilities. ROE is net income over equity. They have negative equity, so you can't really look at this. Interest coverage ratio is earnings before interest and taxes over interest expense, so they can cover their interest payments. Doesn't look like they're going to go into default anytime soon. They have lots of free cash flows as well. Their financial ratios just look really bad. The best way to look at ratios is to compare them to similar companies. I've done videos on American Tower, Crown Castle, Hannon Armstrong, Power REIT, and Iron Mountain. They're all in the same industry as SBA. A popular ratio to look at for REITs is price of stock over funds from operations per share. And the lower the better. Iron Mountain is doing the best in this category. SBA is doing almost the worst. Hannon Armstrong is the worst. So investors are paying $46 for $1 of funds from operations. Funds from operations is net income plus depreciation and amortization minus gain on sales of real estate. Now let's look at the other ratios. In terms of PE, they're doing worse than the average. They're 232, the average is 80. In terms of price to sales, they're worse than the average. Price to book, they're worse than the average. Current ratio, they're definitely worse than the average. They're also worse than the average in ROE. They're 100% debt. In terms of market cap, they are a pretty big company, 34 billion. American Tower is the largest REIT at 108 billion, and Crown Castle is one of the large ones as well at 70 billion. So it looks like a really terrible company when you look at these numbers, but the stock price keeps going up, so people are making money on the stock. So I hope you enjoyed the video. Thanks for watching. Make sure to leave a comment. I always reply to comments. Talk to you later.